Welcome back to another episode of Investing Explained. Here's today's question. Oh boy, I made so many mistakes, I'm not really sure where to start. So let me start my response with the framework of my mistake. So as you might remember, we had Bill Miller on the show on episode 247. And one of the key takeaways was, as a stock investor, we need to distinguish between cyclical trends and secular trends. For instance, secular trends, one example that comes to mind is the auto industry. That has historically been a good example. We always seen cycles in the auto industry depending on where we are in the economic cycle. Basically, in good times, we simply buy more cars, and in bad times, we don't. Or at least we would buy different cars. Secular, on the other hand, means that things have fundamentally changed. So what we see for cars now, for instance, is the trend into self-driving cars. This is not a trend that will change anytime soon. This is a fundamental shift. So if you keep looking back on how companies have made money in the past and assume that it will continue linearly and think that self-driving cars will have no impact on revenue generation in the future, well, then you're likely headed for trouble. That's also why you see some of the car companies right now trading for very low multiples, and why more innovative car manufacturers who are leading the self-driving and electric car movement are trading at really high multiples. Across the board, there is a really good reason for that. So when you ask me about some of the many mistakes that I made, the difference between the cyclical and the secular trends is definitely something that I missed in the past. So specifically for me, it was a mistake that I made investing in Bed Bath & Beyond. So if you consider my mistake in a company like Bed Bath & Beyond, and I guess you could say that for many other retailers, this was a stock that I bought for $21 and then sold at $15 before I realized my mistake. And this was in the bull market, keep in mind, so it is quite an accomplishment performing so badly. But I completely missed the mark. As a value investor, I'm trained to think that small companies grow more than larger companies. And while that is still solid advice, there seems to be a secular trend whenever it comes to retail companies. Because like with so many other goods and services, they're just sold so much more efficiently by machine learning and optimized websites. The small companies are not catching up with Amazon. Amazon is just getting bigger, and the bigger they get, the better they become, because they have more and more data. That's the very heart of machine learning. So the $12 billion top line of Bed Bath & Beyond that I was looking at, it actually showed that it had a harder time growing than the $250 billion top line of Amazon. Even if you only look at the retail division of Amazon, Bed Bath & Beyond simply didn't have what it took to grow retail and compete with Amazon, even though you might think that a $12 billion base would be easier. It's really not. Of course, there are limitations to how much Amazon can grow, but what I failed to understand was that the consumer preference of shopping and the value add of brick and mortar has changed more than I expected. This is not a cyclical trend, this is a secular trend, meaning it's not going back to the way it was before. Of course, as a stock investor, you know that there's typically a good reason why stocks are trading at a 52-week low. And you know that the stock is worth less than it was before very often. But you have to estimate what you think the new lower true value of the stock is and then compare it to the stock price. So even though I was very aware of the impact of Amazon on a company like Bed Bath & Beyond, and I knew that it wasn't worth as much as in the past, I underestimated how quickly it lost value. Much more than the already depressed stock price of $21 that I bought it at. So whenever you ask about the process for mistakes, one process I personally apply is the 2-year rule. This is a rule that I learned from Guy Spear. And that is, if you buy into a stock that you think is undervalued and where value in itself would be the catalyst that you're looking for, if the stock hasn't moved for 2 years, I need a really, really good reason to hold on to that stock, because more likely than not, I'm just wrong in my analysis, and there's a reason why the market has not rewarded that stock. But thank you for the question. I think it was a great question. I think it's very important that we are very open and we learn from our mistakes.
So I think one of the biggest mistakes I made 3 years ago compared to my approach today would revolve around the lack of momentum that was integrated into my approach. I know I've talked about this a lot lately, but it's just kind of such a drastic change to the way I was doing business. I can honestly say that if it weren't for our guests like Wes Gray, Toby Carlisle, Patrick O'Shaughnessy, his father, James O'Shaughnessy, I would have never even began to think about momentum being a type of approach that would augment the way I invested seriously. I have just enormous respect for those four guys and the amount of research that they do for the way that they invest. And I just realized that, hey, there must be something to this. And I dug into it, and I quickly determined and understood that there's a lot to what they were doing. So after doing some research and studying the methodology, I slowly started incorporating momentum into my style. Since doing that, I don't feel like I have my temperament tested nearly as much. This is one of the things that when you go to a Berkshire shareholders meeting, Buffett and Munger always talk about this idea of temperament. They'll say, we were great stock investors because we had the temperament for it. And what they're really saying is they had the stomach for it. They were able to put on a position, it would move against them, and it wouldn't cause them to sell the position, where many people can't say that, and they actually do the opposite of buying low and selling high. Instead, what they do is they buy kind of high, or what they thought was low, only to have their temperament tested, and then they sell even lower. And so that's why I really like momentum, and that's why it's become an integral part in the way that I invest now versus a few years back, is because it's just helped me manage my temperament by not putting on a value pick too soon. In fact, I can identify a whole handful of value picks quite easily at any given point in time, depending on where we're at anywhere in the cycle. I feel like I can list out a whole bunch of value picks at any time. I think the hard part is finding a value pick that won't make you second guess yourself in 5 months or a year. That's because many value-based picks continue to get punished by the market because of psychology, not necessarily because of fundamentals. And so by wrapping momentum for me into my approach, it's helped me not jump on the value-based picks too soon, but to continue to monitor them and then enter them at what I think is a better time, and not have to sit through some of that difficult period where I'm having my temperament tested. So I would say that that's the biggest thing that I've learned in the last 3 years.
That's it. Preston and I will continue explaining investing, so go ahead and hit that subscribe button.